Well, the Reserve Bank made its decision to hold the interest rate steady at 4.1% at the August board meeting. That came as a surprise to us. We thought that the case was quite strong to raise rates by a further 0.25. Some of the arguments that we thought were relevant were the fact that we were still at a 50-year low in the unemployment rate, that services inflation had remained very sticky. It actually lifted from 6.1 to 6.3%, and market services ex-volatile had actually held at 6.8%. We're also aware that they had a tightening bias. So we thought that the case for an interest rate hike was quite respectable, but the Reserve Bank board decided not to go in that direction. We now think that it's very likely that we've seen the peak in interest rates at that 4.1%. Now, if I look back over the last 3 or 4 months, it's been an incredibly volatile ride in terms of the guidance coming out of the Reserve Bank, and it's been quite difficult to pick those rate movements month by month. If I look back a bit further to February, our view then was that the cash rate would peak at 4.1% in May. As it's turned out, it looks as if it's peaked at 4.1%, but in June. So back in February, we were very close to the medium-term outlook, but picking those month-by-month movements has proved to be quite a challenge. We didn't expect that the Reserve Bank would change its forecast for the path of inflation based upon the June quarter report, and indeed that was the case. Indeed, they still believe that inflation will reach 3.25% by the end of 2024. They do now, however, they've extended their forecast from June 2025 to December 2025, and they expect that by December 2025, inflation will be back within the 2 to 3% band. But it just doesn't look as if they've been confident enough to say it'll be back at the middle of the band, at the 2.5. When I was overseas, there was quite a degree of unrest with regard to the fact that the Reserve Bank seemed to be taking so much longer to predict that they'd be back at the midpoint of their band. Indeed, this extension to the end of 2025 still hasn't resolved the fact that they are not necessarily forecasting the middle of the band. We'll find out when we see the statement on monetary policy in a few days' time, but the fact that in the first half of 2025 they're only predicting 0.2% fall down to 3%, it's unlikely that you'll be able to accelerate that fall in the second half, because they're predicting that growth in 2024 at 1.7 will lift to 2% in 2025. Now, one of the reasons why in the last 2 months that we've seen this incredible improvement in the labour market, an incredibly low unemployment rate, and yet the bank has remained on pause, seemed to be coming out in one of the comments that was made in the governor's statement yesterday, when they raised the view that it was uncertain as to the impact that tight labour markets would have on pricing when they were associated with very weak demand. So the question is, will firms be able to pass on any wage increases when demand is so weak? And that is really questioning that whole model where in the past we've thought tight labour markets necessarily lead to wage pressures, which will lead to higher inflation. The bank seems to be questioning that view, and there is some justification for that given the evidence that we've seen, particularly in the US, where the unemployment rate is stuck at around 3.5%, and yet we've started to see quite substantial progress in bringing down inflation. The other nuance that I think we saw yesterday in the statement was a rebalancing of this issue about inflation and a weak economy. And I think what we're starting to see is a Reserve Bank starting to give bigger priority to that economic weakness relative to inflation, particularly given that the forecasts are now for inflation to continue to fall. And that would tend to give some justification as to why we've started to see the tight labour market take a back seat to concerns about economic growth. We also saw a discussion again about productivity. So productivity is clearly an issue that they have a great significant difficulty in dealing with. If productivity remains at this weak level, then you have to assume that for a given level of wages growth, you'll have more inflation. And the indication is that our forecasts are based upon a return to modest productivity growth along the lines of what we saw before the pandemic. But there's no argument as to why that's likely to happen. And indeed, after the July board meeting, we saw that unit labour costs had lifted from 7% to 7.9% annual in that March quarter. So the productivity story continues to represent a challenge. What do we think about going forward now? Well, as I said, I believe that rates are now going to be on hold. The September board meeting is still a live meeting. The bank still has a tightening bias. We've seen how sensitive they are to those monthly inflation reports. Back in June, when we saw a lift in monthly inflation from 6.3 to 6.8, we saw a rate hike at the June board meeting. Back in July, when we saw a fall in the monthly number from 6.8 down to 5.6, we saw a pause. And then again at this meeting, at the August meeting, we saw another fall in the monthly number from 5.6 to 5.4, and we've seen a pause. So policy does remain vulnerable to those monthly inflation prints. It's also true that the wage price index for the June quarter will be released before the May board meeting. We're expecting a fairly strong number of around 1%, but I don't think that's enough to move the dial from a central bank that looks and feels as if their hurdle for raising rates is just got that little bit higher. So if we believe that rates are on hold from here, what's the next move? Well, the next move is the timing of the rate cut. Now, we did expect that that rate cut would come in the June quarter next year, but now that the level of rates is only going to be 4.1% compared to the 4.35 that we were expecting, then I think there's enough argument to say that you need to push back the timing of that rate cut. Question marks around that productivity story, putting some upward pressure on risks to inflation next year. And of course, if rates are only at 4.1, then the slowdown in the economy that will be the major signal to say it's time to start cutting has to be revised back. And we're reviewing our growth forecasts at the moment, and they'll be available in the Westpac market outlook for August that will print at the end of this week. Once we start to see the rate cuts coming through, we expect them to be relatively rapid, about one rate cut every month, every quarter for at least the next 12 months or so, getting the cash rate back into that low threes that we think is slightly below the neutral level. And you need to get below neutral if your economy is growing well below its trend, and that's why we would expect to see once the easing cycle begins, it will be sustained well into 2025, because by then, of course, the inflation target will have been achieved. So many uncertainties. It's been quite a ride in terms of the last few months from the Reserve Bank policy making perspective, but we think we've come out the other end now. We're looking for a period of rate stability, with the eventual next move being rates to come down in that September quarter of next year. Thank you very much.